is special because Jaden Doy is here. Now, if you're a business owner or a professional or even just someone who's managing your personal life, you want to keep as much money as you make, right? It's not how much you make, it's literally how much of it you keep. And
Mm.
keeping as much money as you can, dealing effectively with the taxes you pay. So today's question is, what are your options when dealing with a large tax bill? Our expert guest on the matter is CPA Jaden Doy. Jaden was not always the financial guru that he is today. Growing up in a household just shy of the federal poverty line in Prince George County, he knew the importance of money management, but didn't have the tools to create the financial stability he so desperately craved. Now, with a little hard work and a lot of sacrifice, Jaden did become independent, gained professional growth as an accountant at a small CPA firm in Atlanta, and became a certified public accountant. Over the past 5 years, he's worked with clients in just every industry, helping them not only expand their financial portfolios, but create plans that ensure financial sustainability and minimize taxability. As a CPA and as your expert today, Jaden's purpose is to help entrepreneurs just like you gain independence and create unique action plans to bring more to their bottom line while paying less taxes. I've posted Jaden's contact information in the chat. It's also available on the Facebook page. And I am so delighted and happy to introduce to you CPA Jaden Doy. My good friend Jaden, welcome. Good morning.
Good
Go up,
morning. Good
take it
morning.
away.
Thank you for that wonderful introduction. Thank you so much for that. Again, my name is Jaden Doye, CPA. I'm the president and founder of Prestige Accounting Solutions. And today I am going to talk about everyone's favorite topic, taxes. So many times I've come across clients who they get that dreaded notice in the mail. It looks something like this, right? And and the first instinct is to panic, and then they just think, okay, well, let me just go ahead and pay it so that I can get them off my back. No, that's incorrect. So today I'm going to talk about the different options that you have when you have a bill that you feel like is just so heavy that it's weighing on your shoulders. So today I'm going to talk about IRS collections and also back taxes. There's actually more options than people think than just paying that, just paying it over and over again. And so I think it's very important to discuss those options. Again, I'm a tax planning specialist, and my contact information is here and is also in the chat. Now, like I said, there are options, but there are also rules. You also have to make sure that you are filing all overdue tax returns. So before my team can do any tax resolution work for any client or prospect, the IRS wants to make sure that the client is in compliance. So making sure that all tax returns are filed, both personal and business, is very important. Some people think that if they don't file their taxes, then they won't owe taxes. And I'm sorry, but that is actually incorrect. And then you want to also make sure that you stop accumulating more tax debt. So once the reason as to why the tax liability is so large has been solved, then there's a planning process that has to go forward in the future regarding not getting there again. So when it comes to taxes, there's some tax vocabulary that I think is very important that we specify the differences. So there's a tax lien and then there's a tax levy. So I'll start with the tax lien. So a tax lien is a public notice, and it's attached to everything you own, including cash. And after 180 days, it supersedes other type of tax lien except for property taxes and mortgages. So a lot of people don't know this, but as soon as you are issued that notice that you owe the IRS, there's a 99% chance that there's technically a lien that has already been filed against you. Sometimes it doesn't hinder you as far as selling property, but if it's a large lien, it definitely will. So, a little bit about liens. You cannot sell or transfer property covered by the lien, which is everything, without requesting a certificate of discharge. So sometimes there's people that are trying to sell a home, but because they're in the middle of a tax lien, that can be a hindrance. When refinancing real estate, you must subordinate the lien to the new mortgage. The IRS will make sure they will get their money. And don't expect to get the lien completely removed in the event that they do give you the opportunity to sell your home while you're in the lien. All right, now let's talk about a levy. So a levy is the actual taking of the money. Most common levy sources are bank accounts, paychecks in the form of wage garnishments, and accounts receivable. This is definitely what you do not want. This is before it even gets to the levy level, there are a lot of correspondence that you will receive, and the IRS will try to work with you. But if they don't get any type of response and you're not trying to resolve this debt or you're not working with a professional to do so, they will take money out of your bank account. They'll let you know first. They're nice enough to do that, but they will take the money out of your bank account. There's also an option that they will garnish your wages, and they might even take your accounts receivable. So other companies that owe you, they will now owe the IRS. Now let's talk about why someone will be levied. Levied levies are usually used by the IRS personnel as a wake-up call. So this is why, like I said, it's always important to make sure that you're responding to those notices on time. Return a phone call from the revenue officer, which is very unlikely. By the time a revenue officer, an actual revenue officer calls you, that means that it's getting to a pretty high level, and never ignore them. Levies can be appealed through special process, and levies can be released. Now, if you want to get out of a levy, you have to expect to provide full financial information. You must demonstrate that the levy creates financial hardship, and banks must hold funds 21 days before sending to the IRS. It's a pretty inconvenient process that you don't want to be. Now, let's talk about the tax resolution options. There are three so-called pathways outside of refiling the returns. A lot of times I've come across clients who simply went to, a small tax shop around the corner, and unfortunately that tax preparer was not knowledgeable on how to file business taxes appropriately. So unfortunately, the tax returns were filed incorrectly, and that resulted in a large tax debt coming. And then sometimes you try to call the tax preparer, and you realize, oh, they're out of business or they're in jail. So let's talk about the three pathways: currently not collectible, installment agreements, and offer in compromise. So when it comes to currently not collectible, this means that you have negligible assets and no income beyond what is required to live. And if that's the case, then you may be eligible. Pretty much the IRS will take inventory of what your living expenses are. They're going to look at your assets, and they're also going to look at your income to verify that if you were to pay on this debt, then you would essentially not be able to live. Some eligibility factors that are regarding currently not collectible are: you die with no significant estate left behind, bankruptcy of the business activities with no remaining assets, or special circumstances such as tax accounts of military personnel serving in a combat zone. Some things to keep in mind when it comes to currently not collectible is you will, like I said, have to provide full financial documentation. So all income and expenses, living expenses, groceries, mileage, all of that good stuff, all of your assets, all of your liabilities. And it usually lasts for a year, and then you have to reapply every year. Some more things to keep in mind is that penalties and interest will continue to accrue during that process that you're currently not collectible, even though they will pause on sending you notices, they'll pause on collecting. Those penalties and interest will continue to grow. The tax lien will not be removed. So if you're looking to sell property, this will not guarantee that you're able to do that. Now, the good thing about it is that you could actually reach the statute of limitation on the tax debt, and then you wouldn't have to pay it at all. But that takes a while, so don't bank on that. When it comes to installment agreements, there's many benefits regarding installment agreements, and during those installment agreements, you won't get those collection calls, potential automatic penalty reduction, seasonal adjustments if necessary if you have a seasonal business, and many people actually have to never pay that full amount that they got on the original notice. Some of the downsides are that there's fees to even get to apply for this. There's monthly payment option. Every month you have to make a payment, and penalties and interest is still accruing. So with installment agreements, there are a few type of installment agreements. There are guaranteed installment agreements, streamlined installment agreements, and then in business trust fund installment agreements. Now, for the essence of time, I won't go into the details of the different installment agreements because I definitely want to make sure that I'm touching on offer and compromise because that seems to be the most popular option. And I want to talk about that so that people understand that, sometimes that's not actually your best option, and that you might not even be eligible for that offer and compromise. All right. So with the offer and compromise, you're pretty much reducing your tax bill by settling at a lower amount. So you're settling your tax debt for less than what you owe. You're eliminating penalties and interest, and there's no enforced collection activity, and there's no limit to the amount that can be settled. Government cannot later reopen the case. Low income qualifications may waive the application fee, so that's a good thing. Lien removal upon payment of offer compromise, that's another good thing. And there's reasonable alternative to the installment agreement or currently not collectible if you're not eligible for those. Now, there are some downsides. You do have to pay a large amount of cash at once. So I've seen it in practice where sometimes somebody might owe $100,000 and they might make an offer to pay $25,000 and they have to make that at once. There's an application fee of $186. There's full financial disclosure required as well. The forms that are required for that, especially as a business owner, there's one form for the business and then one form for the personal, and that can be a pretty long process. Also, it also extends the collection. The CSED that pretty much touches on the period and time in which the IRS can come back and collect, and keep the case open. There's closer IRS scrutiny for 5 years after. So if I ever do an offer and compromise for a client, I make sure that they pay for the next 5 years of tax returns because I am determined to not put them in that same situation again. And then there's legal opinion of the IRS counsel required for all liabilities over $50,000. So doing an offer and compromise for someone that's less than $50,000 versus over $50,000 is definitely a totally different process. So here are some of the requirements. Tax liability is not reduced to judgment. No pending litigation, criminal or civil, in regards to the tax period in question. And the OIC must include all tax liabilities. So with the lump, like I said earlier, with the large cash upfront, there's a lump sum cash offer where you do 20% down payment and no more than 5 additional payments within 24 months of acceptance. Now, there's also a periodic payment offer, which is, like I said, with the first payment made with the offer, and then monthly payments made during evaluation. Now, the evaluation process can be a pretty long process. I've seen it go from anywhere from 6 months to 16 months. So it cannot be zero. So don't think that you can just say, hey, I'm offering to pay you $0 on this $20,000 debt that I owe you. And the total amount the IRS can collect from you in 2 years, they pretty much use the present and future value of your income, the 5-month rule. That is a whole nother topic for another day. And they also look at your assets when it comes to that. So that also I want to talk about this before I stop this. There's a look back period for returns that's generally 6 years. And when it comes to the business offers, trust funds must be paid, and individual offers must include those funds as well. And I'm going to stop the slideshow there so that we have time for questions.
Jaden, this is great. Thank you so much. I think you've sufficiently shaken and awakened us to what that is. And I've got a question in my mind to kick it off. As a business owner, whether I'm a solopreneur or the owner of a huge corporation, I'm assuming that the tax liabilities, though in amount they may not be the same, they're really the same. There are taxes that business owe, and if we know what those are and we plan for them, we can avoid getting to where you're talking about. So what are the taxes that are owed by a business regardless of size, and what is the frequency of payment, and how do we plan to avoid getting to where you're talking about?
That is a great loaded question. So the actual amount of taxes and who pays the taxes is based on the entity. So there's the IRS will look at a business or a business owner either as a sole proprietorship, a partnership, an S corporation, or a C corporation. So long story short, a C corporation is the type of entity that pays the taxes on through the business. However, a S corporation is a pass-through entity. Therefore, the business owners, the shareholders rather, are responsible for paying the tax liability. So if there's an S corporation that has one owner that's 100% owner, then that S corporation will file an 1120-S, an informational return. And from that, a K-1 will be generated, which is very similar to a W-2. And that will be attached to the business owner's individual return. And that net income, the net taxable income on that is what the business owner pays taxes on. So the tax planning process is very important for business owners to talk to their CPA throughout the year and have their CPA review their income and project their future income so that they can project their tax liability for the year and make quarterly payments. The IRS expects self-employed individuals to pay at least 90% of their tax liability within that tax year through quarterly estimated payments. So when I'm working with clients, right now we're in a pandemic. So everyone's income is either skyrocketed or it's going down. I haven't seen a lot of people that have been steady through this pandemic. And when there's changes like that, it's very important to put into play the planning process within that process. So I can't say, like, some people would have just been given an estimate last year from their CPA, right? Let's say the CPA would have told them to pay $10,000 based off of their 2019 income. However, 2020 income has changed so dramatically that every quarter, at least every quarter, that those estimates need to be readjusted. So for my clients, we're either working every month or every quarter to make sure that we're still in line with that tax plan and that they're not overpaying the IRS.
Thank you, Jaden, for that. So whether or not you're going to pay a lot or little, the rule of paying 90% of what you would owe through estimated tax payments on a quarterly basis holds, right?
Pretty much. And a lot of people don't know this, but if your tax liability is over $1,000, a lot of times you're charged an underpayment penalty. So a lot of times when I'm having consultations, someone will tell me I had to cut a $20,000 check to the IRS. I tell them, well, your tax preparer may have not let you know, but that there's definitely some underpayment penalties included in that. And that's the result of just not planning throughout the year and making payments on a quarterly basis.
Great, great. Giovanni, I think we open it up to questions and concerns from the studio audience and Facebook. Do you have anything?
No, right now I don't have any questions. I'm being with all of it. I have to say that I didn't know, and this is so great about the Daily Huddle. I didn't know that I could make an offer for the tax that one can incur for a while. I didn't know I could make an offer of 50% or 25% on a cash advance. That's pretty good. I didn't know that was possible, and I learned that at the Daily Huddle.
Yeah, and I didn't know that you had to pay 90% of what you owe through estimated payments. So I know each of you who are here are probably, your wheels are turning right now. You're saying, okay, what's necessary to do is to plan on an ongoing basis to estimate what I'll owe when my taxes are due and make quarterly payments to get to the point where I've done 90% of what I could owe inside the tax year. So given that, I'd like to see a show of hands. Where are you? How many of you are actually filing taxes and making estimated payments on a quarterly basis? Raise your hand. Jaden, nobody. So that means
that's okay.
So that means no one's actually planning on an ongoing basis.
But it's like, how many of us have the intention to do that? Everybody. How many is actually sending the check? Then that's kind of fluctuates. Yeah. I have I don't send the check, but I have a savings account that goes to the tax. It's my tax savings account.
And you pay it. So
At
you
the end of
accumulate
the
the saving. Okay, so here's the problem with that.
Yeah, tell me the problem with that, Jaden.
The problem with that is that the savings account is accumulating a interest rate of what, 0.5%, versus the interest that you're accruing on your tax debt can be 3 to 5% and up from there. So you're costing yourself money by doing that. There are also streamlined ways of paying your estimated tax payment throughout the year.
Quick question, Jaden. I don't have any taxes that I owe. Are you saying that the potential taxes that I'm going to owe is accumulating interest rate?
Yep, because you're going to receive that underpayment penalty.
But that's if I owe back taxes, right?
So all the money that you're making during 2020, the IRS is expecting you to pay that during 2020, ideally. So if you're just let's say that you know that your tax due is going to be $10,000, or let's say $12,000,
So
and
that's the speculation, yeah.
every month you put $1,000 into a savings account, and
Right,
then when you file your return in April, you go ahead and you pay that 12,000.
right.
It's going to be 12,000 plus an underpayment penalty, and that penalty, when
For
you do
real?
the math, yes,
What?
absolutely,
What? And I
yes.
learned that at the Daily Huddle. I'm so upset. Oh my God. Okay, go ahead, continue.
And I was just gonna say that percentage rate, when you do the math on that underpayment penalty, is always going to be higher than the interest rate that you put in the savings account.
And that's not necessarily, I'm sorry, Andrea has a question. I'm just going to throw this. And that's not necessarily the case for W-2s, or that's the case for everybody?
Well, W-2 is a little different because you're paying it throughout the year, but a lot of self-employed individuals are also W-2 on their business, which is how you can get a that is how you pretty much pay your taxes throughout the year through your withholdings from on your W-2.
I learned something now. Oh, I'm
Hmm.
so like, go ahead, Andrea.
Thank you. No worries, Giovanni. Thank you so much, Aiden, for this. This is a lot of information and it's really opening our eyes, particularly on a Monday. You're like, oh crap, I need to do a lot of work. My question is related to the last part of Giovanni's question. Is it the same for people that have an LLC that just started? Let's say I started my business this year. I was an employee of another company last year. It doesn't have to be me particularly, but it is a different approach for LLCs, correct?
Well, it depends on an LLC is the legal entity.
Mhm.
However, I don't know how that LLC is taxed, if it's taxed as a sole prop or a partnership or S corp. But if that LLC is profitable, then there needs to be some type of estimated payment during that calendar year,
And you
even though you were W-2 and LLC. And uh,
got it.
and also, to that point, that's a great point. A lot of my clients are in that transition phase. So when I'm doing the estimate, I'm also putting in to play the numbers that were on the W-2, and also their self-employment to kind of weigh what we have to work with.
Yeah, that was the point of me. Like there are people in transition. Therefore, they do need to have somebody that helps them with plan. Is more we tend to think taxes as more as a reacting thing. And what I've learned from my CPA is actually no, I'm your planner. So we need to
Hmm.
change our mentality about planning and reacting. It's not a good thing for taxes.
Correct.
Thank you.
Awesome. Rose Hampton.
Hi, good morning. Thank you, Jaden.
You're
So,
welcome.
okay, so so I just wanted to clarify something. So, yeah, so we have an obligation to file a quarterly um, estimated tax amount in payment, right? Equal to 90% of what we expect to owe. I did not do that. And this year was a little unusual because we had the extension, but I still didn't have all my documentation ready. So I filed an extension. I filed for an extension, right, which will give me until October 15th with
Okay.
an estimated, tax payment of what I, based on last year's tax return, what I think I owe. But will I still get charged interest on each quarterly amount that was less than 90%? Do you know what I'm saying? So like I should have filed like my first payment in like April 15th, right? For the first quarter. But I didn't. So will I still get taxed? Will I still get an interest charge based on that quarterly amount that was due that I didn't pay?
So I'm assuming we're talking about the 2020 tax year, correct?
2019.
Oh, sorry. Yes, 2019. So, I mean, it's possible. I mean, when we do the tax return, there's another form that we have to fill out a worksheet in order to calculate the actual estimated tax penalty. So depending on how much you paid versus how much you owed and the timing of those payments, that will determine if there is an estimated tax payment penalty.
So I
So-
didn't, so the first quarter's estimated tax payment would have been due April 15th,
Mhm.
right? And I didn't pay that.
Okay.
But when I filed for my extension, I figured what I owed for the entire year. But I
Right.
didn't make those quarterly payments along the way. So even though with the extensions, I sent a check for what I think I owed, the payments were not timely. So can they still charge me interest on
Yes.
each quarterly payment not paid? So it's really, it could be penalty, underpayment penalty, if I haven't paid enough. It could be
Correct.
both underpayment penalty plus interest on each unpaid quarterly payment.
It's possible. I'll say that it's possible. Let's get that tax return filed as soon as possible, though.
Yes,
And just another reminder, the extension is an extension to file, not an extension to pay. That's just for everyone,
Extension to file, not to
not to
pay.
pay. Yep.
Owe that money, pay that money. Mary Campbell, I noticed you had your hand up and you took it down. Was your question answered?
Yes, and so I have a time too, but the question I had was, I had a couple of incidents that happened in the last 5 years. One is, I had a significant amount of credit card debt that I was paying on, and then they started sending my payments back to me like in November, and in January they sent me, had written off like $45,000 worth of credit card in January for the 2019 year. And I owed taxes on that. But since I didn't receive the money until the last quarter, I didn't put in a quarterly income tax estimate. And at this time I was working in Alaska, so I was making more money. So I wrote a IRS check for over $11,000 to do that. But one other thing that I had was, part owner of farming, which sold off the pulpwood off the farm, and so I had a significant check in. And I think I did not pay. I don't know that IRS knew that I had gotten that check until I just filed it towards the end of the year. So maybe I had 90% sent in from the job that I was getting when I got my K-1. But do they, like if I had gotten a significant amount of money, like in June, would they know until I pay my taxes in the spring?
They'll know based off of what has been filed. So you mentioned the K-1. So if the K-1 was filed, then they'll know that you made that money, just like they know with the 1099-C that you received for the cancellation of debt. And usually
Do they know when?
I'm sorry?
Do they know when I got that money? Did they know that I got that money in June rather than in December of that year? I mean, I sent the K-1 in and I paid the tax. So did they know? I don't know whether they know.
So with property sales, there's something called a 1099-S, where that's filed with the IRS that says pretty much this real property has been sold and when it's been sold. But if you're just receiving a K-1, then the timing of that doesn't necessarily always get reported to the IRS because it's
Yay.
based off of an annual basis.
Okay, got it. Thank you.
You're welcome.
Great information. I really appreciate your sharing this morning.
No problem.
Thank you, Mary, and thank you for everyone who participated. Now, Jaden, I think you've stirred a pot here, or even opened Pandora's box. What are your last words for business owners?
My last words are to be, I'm going to take a line from Andrea, be proactive, not reactive. planning is very important.
Yep. That's the name of the game when it comes to taxes and being a business owner. I'll hand it off to you now, Giovanni, to send us home.
Very good, Zarel. Thank you, Zarel. Jaden, thank you so much for being here, for sharing your expertise and giving us time of your day. This has just been very generous and I love it. You did stir the pot sufficiently for me to be upset. So thank you very much. And for the rest of us, thank you for being here. I love you. Don't forget that we're only 2 weeks away from Access the Leader Within, our leadership retreat, an entrepreneur retreat that Sorel and I will be leading virtually next week, Friday, Saturday, and Sunday from 10 to 6. It's going to completely rock your world and exponentially grow your business. Don't miss the opportunity. Don't leave it for later. Be proactive in investing in yourself and investing in your business. It's only $97. And like a friend of mine says, that's probably what you spend in the movies when we used to go to the movies. I love you. Have a phenomenal rest of the day. And we'll see you tomorrow at 9 in the morning. Bye-bye.
Until then.
Bye, everyone. Thank you.
Bye, everyone. Thank you, Jaden.